And once the asset class breakage occurs in the bubble market, the stock market, the U.S. stock market in particular, that money goes somewhere. It always does. It doesn't get burned up. Yeah, some of it gets burned up, but a lot of it goes somewhere else. And gold is almost always it's gold and monetary metals are the prime beneficiary. And so what we've seen in gold and silver is going to go more vertical, particularly in silver.
You're watching CapitalCosm. My name is Danny. It is September 17th, 2025, and it is Fed Day. And my guest today is none other than Michael Oliver himself. Michael, thank you so much for making time to come on the show.
Good to be back, Danny.
Yeah, let's dive right in. Explain to the audience what this 25 basis point rate cut means for the stock market, for precious metals. President Trump is already, dogging it, making fun of it on Truth Social. What do you make of it here?
It doesn't mean anything except that historically we've run reports on this before. If you go back and look at the 2000 bull peak in the stock market.com top, and you go back and look at the 2007 top, when the Fed started cutting rates after a pause period, where they weren't doing anything, they start cutting rates again, circle it, or we put a little tombstone on the price chart and called it a tombstone event, because at those points, there might have been a rally, because in those two cases, it was January 2001, actually, there were two rate cuts, not far off the high that occurred in the summer of 2000. Fed came in and cut twice, and there was, hey, let's buy this, so forth. And you went to hell for 2 years, okay? NASDAQ 100 dropped 82%, and S&P dropped 50%. And then when you go to 2007 and look at a monthly chart, right over there, you came up to the highs. In fact, in late 2006, our last report, December of that year, we predicted that you'd go up into 7 and top. And our predicted zone was 1550 to 1600. The old high in 2000 was 1550, okay? And if you carry across in spring of 2007, you went up to 1550 again, okay? Mm-hmm. And they sold it there. Some price guys, jockeys said, hey, let's sell the old high, okay? And they made, maybe 100 points or so. S&P dropped off. But then it came back up in the summer and into September of 2007, approaching again that high. And the Fed Bernanke cut with a surprise half-point rate cut. So it was not built into the market. It was not priced in, anticipated. And you had a shoot up in the market, and it got right in the middle of our target zone, which was 1550 to 1600. It got to 1576, I think was top tick, about 3 weeks after they'd cut. So you had this nice little party of buying, oh boy, the cut rates. That was a tombstone. It was it. It's the top. Even though you took out a 1550 high in 2000 and a 1550 high in 2007. In October of 2007, you took them both out. And therefore, if you were a price jockey, you'd say, oh, it's a breakout, right? Okay. Well, it was the top. So ignore price. And, again, you had a major puke in the S&P over the next 2+ years. They cut rates all the way down. It didn't matter. So now we have a situation where after a pause of a year, they finally cut rates again, this time by a quarter point, but it was fully priced into, meaning the market knew they were going to do it. Before this ever happened, we were up in the 90 percentile where it was anticipated they were going to cut rates by a quarter point. And so buyers bought into the market. Boy, they're going to cut rates. Well, the question now is, do you rally after the rate cut, or is it already priced in? Mm-hmm. In other words, you've already done your little enthusiastic rally based on the cut, which you knew was coming. We suspect that's what it is. It's another tombstone. And we know that as data gets worse, it probably will, the employment data. We just had a horrible housing starts data, I think, today. I didn't look at the number, but I heard it was horrible. The Fed will accommodate. And though Powell might not want to, he's got enough voices on the Fed to say, no, we need to cut some more. Whether it's quarter here, half here, I don't care. They'll start on a process of cutting rates, and it won't help. It didn't help in 2000. It didn't help in 2007. The market went into a major bear. So rate cuts were, in effect, the reverse of what you think. Instead of good for the market, they were tombstones.
Right.
So that's my intellectual answer to your question. What economic effect might it have? It's an indicator, I think.
Yeah. So just so the audience knows, we've got the top chart here. What we've been looking at is the S&P on the top and the Fed funds rate here at the bottom. And just like you said here, Michael, when
look at that collapses. Yeah.
Yep. When the Fed funds rate interest rate comes down, so does the market. In both of these cases here in 2000 and 07, and even all the way out here as well. As early or as late as 2019, you had a rate cut.
Well, that was the COVID event. Yeah, they went back to zero again, and so 10 of the 15 years we've had free money, Cheech and Chong time. Get high, okay, and the market's gone up accordingly because there's been enough money printed to hey, let's put it somewhere, okay, and they chose the stock market, which is typical. And we have the biggest stock market bubble in U.S. history in terms of age and dimension.
And what's peculiar about this?
What?
I'm looking at it here on the side. So if I pull up the TNX, the 10-year yield, it's actually up today, 1.24%. If I pull up the 30-year yield, it's up 0.6%.
Yeah.
So why are yields going up on the news of the Fed fund rate going down?
It may be that they've anticipated it too. It could be part of it. The T-bond situation, though, we think there could be, if you can hang in here this month, there's another, couple of weeks, so, and close the week out, not far from where you are now, close the month out, excuse me, you're probably going higher in price, lower in yield. So that dip we're seeing today in price and up, et cetera, you'll continue up as an alternative to the stock market. I think part of the strength in bonds lately was not the anticipation of Fed rate cut, because when they cut rates back September a year ago, T-bonds collapsed and rates went higher on the long end. They didn't go lower just because the Fed cut short-term rates. This time, I think the reason the T-bonds are firming is that there's enough asset managers out there of size who've been around long enough to know it's time to be suspicious. And therefore, if I'm suspicious of the stock market bubble, which is some people know that's what it is, they got to put it somewhere. And T-bonds have traditionally been, the 60-40 rule, put it in T-bonds. It hasn't worked, lately, because T-bonds have been, frankly, following the stock market almost, especially into April. We had a collapse in the T-bond prices along with the collapse in the S&P. But I think it's probably due to that. That's why you're getting a drop in the longer end rates. It's been going on for several weeks now, by the way. Okay. And I think it could go for, several more months if they do the right technical things at the end of this month, like basically hold these gains we've seen. I think you could get some more. And that would indicate to me probably you're going to get weakness in the stock market. And what you've had that's been buying T-bonds is not it, or asset managers looking for a safer place to be.
Yeah. Well, as elevated as the U.S. bonds are, let's take a look at some of these foreign bonds. So if you look at the Japanese, what is it, 10-year?
Yeah. What was it?
So let's pull that up. That's been on the move lately.
Yeah.
So that's been up there quite a bit. That's continued to go up.
Those are yields again. Yeah.
Yep.
Not price. Yeah. Okay. Yeah. Well, I mean, government bond crisis is not just limited, and we had a mortgage crisis in 2007 onward. In fact, it was before then. Remember the big short guys, they knew it was coming 2 years before. Finally, it showed itself. And they were right 10 times more than they thought. This time we get government debt crisis. Not just U.S., Japan, Europe, the whole, that's not something you just shrug off. And I think Jamie Dimon even made the point. He says, this, we keep doing this thing over year, administration after administration. where the debt gets bigger, et cetera, in ratio to the GDP. This can't continue. There's going to be a point where finally it reaches a fever crisis point. I think we're there. Now, I do think, though, you could get a short-term rally in T-bonds. I don't think it's going to go far because the long-term trend of T-bonds prices is down, therefore higher yields. I think the only thing you would see if T-bonds rally now is a brief several-month reprieve, what we could call a counter-trend rally, counter to the major bear trend in bonds. But that's all I think is going on there. And ultimately, I think this market, you got German bonds here, is a crisis event that can't be put off forever. But there's other big factors at work out there, too.
Does the bond crisis occur outside of the United States first and create a
I
contagion?
don't know. We could be in sync with them, too. I don't know. It's
understood.
We're all in deep S, okay? And they can try to play games, but ultimately we're in a different world now than we've been in prior potential stock bear markets, for example, or bull markets in gold. The fundamentals that underlie those events are far more potent this time, either in a negative way or a positive way, depending on the particular market, than it's ever been in my career, my history of knowing markets. And this is going to be a different outcome, different dynamics in a lot of places, not just in what T-bonds do or the stock market does.
And the currencies, talk about the DXY here. The DXY has been, it looks like it's been breaking down below the support line. What's your view on the U.S. dollar?
When you run, well, remember, first off, the U.S. dollar, this is not the real value of the dollar. This is the value of the dollar versus the euro and the yen. They constitute 70% of it. So it's one piece of paper versus two others, or there's more than that, but those constitute 70%. So it's not the real purchasing power of the dollar. So when the dollar rallies on this chart, it doesn't mean it's worth more. It just means it's worth more than those other guys. Okay.
Relatively. Yeah.
Yeah. You've been going up since, 2011 or 7, 8, 9 period. Okay. You got up to 115 in 2022, and then you puked down. But you'll notice once you dropped into 2023 and 2024, you went dead sideways in about a 7% range up there, off the high of 115, but just dead. There was nothing going on for almost 2 years. So it wasn't a player. It wasn't causing any movement elsewhere due to its movement. At 104, when we came back down off that late year high, which got up to about 110 very briefly, but it came back to 104, right about there. It come back down about halfway in the middle of that ink. We turned major bearish. And we said, you've broken the major uptrend going back, more than a decade. Not on price, but on momentum of price. Annual momentum of price, you're well below the uptrend you see on price there. So when you run a 10-year average oscillator or a 3-year average oscillator of where is price in relation to those averages and plotted as an oscillator, you had the same kind of trend line, but you've blown it. And you did that at around 104. Well, where are you trading now? 96. Okay. It's no question that you got some price guys for the last several months. In fact, back in April, you got almost down to that line. So April, May, June, July, August, September, for 5 months, they've been buying and buying on that line, hoping that the line will support them. Momentum says it's not going to. And right now we're back down to the lows again, back down in the 96s. Once you get much below there, even the price chart guys are going to say, uh-oh, it didn't work. And I think this thing could implode enough where over the next year or two, we could be down to the 70s again.
Wow.
That'll have wave effects. So far, the dollar, for example, has not had wave effects on gold. We see your horizontal line there. You've got at the top, that white line, you've got the horizontal up there. Yeah, that one. That goes back to about 2015. That's when gold made its low over there on the left, the left side of that white line back in 2015. Gold has tripled in half, yet the dollar has gone sideways on either side of that line. So the dollar didn't need to go down to take gold up, because where we were 10 years ago.
Right. This is
the point I'm making. So it's not like if the dollar goes down, that's critical for gold. No, gold's tripled in half since the dollar was already at the current prices where it is now. But if you do break the dollar and you get some dimension to it, speed, for example, it's going to cause headlines and it's going to cause movements in other markets, asset movements, and it's going to help benefit gold.
Hey guys, quick pause from the podcast, but this is something I feel is really important to let you in on. Back in 2020, before I even started this channel, I was looking for an edge, a way to find the big opportunities most investors never even hear about. That's when I found Capitalist Exploits Insider. From day one, it felt like I suddenly had my own team of world-class market pros working for me, digging up trades all over the world, doing the deep research, and handing me ideas that had massive asymmetric upside. Stuff that I would never even think about. Since then, my gains with them have blown past the S&P and the NASDAQ, and it's honestly the single best newsletter I've ever subscribed to. And that's not me blowing smoke. That's for real. I've interviewed their publisher, Chris McIntosh, more times than I can count. In fact, my latest conversation with him is linked in the description box down below if you want to check that out, as well as a pinned comment. And every time, I'm reminded why I've stayed a member for years. Right now, they're offering a special $1,000 discount on the Insider subscription, but it's only for CapitalCosm viewers, so you're only going to get it by clicking the link down below in the description box or the pinned comment. You're not going to find this anywhere else. Click the link, lock it in, and start getting the same game-changing research I've been using since 2020. Yep.
It didn't need it up to this point, but that'll just be a little extra fuel for gold to continue on up. And I think when you, again, looking at the price chart, you see a 4-point trend line. You're sitting on it for the fourth time. Good luck, folks. Okay. Momentum says you've already broken it. And momentum usually leads. And I think when you get another point or two lower, they're going to realize that. And then you'll start hearing headlines about dollar.
Yeah, we have the gold chart plotted here down below the DXY chart.
It didn't care. 2015, if you can line them up. Yeah, you've got them lined up. Okay. See gold and see where the dollar was. Okay. Mm-hmm. Gold's tripled and dollar's going sideways. So don't look at the dollar as a pivotal issue for gold. It could help. It could be a further fuel injector into gold's already dynamic trend. And it will be. But it wasn't instrumental in getting gold up to where it is now.
Gotcha. So speaking of gold, let's go ahead and take a look at that now. Currently at 36.93. Let's go ahead and shift over to the daily candlestick. Big red candlestick today.
Yeah. You're going to get some. We put out a report last night before we opened and before the Fed event today. There's a good chance you're going to get a correction in the gold miners in particular that's going to be noticeable. But I think it's only going to last about a week. And I think it could, it could smack some people and they say, oh my gosh, I'm getting killed on the miners. No, you're not. Put up GDX if you would. Monthly would be fine. It's the gold miners. Go back to 2011 if you can. Yeah. Okay. The high there was around, 60 something. Okay. And you blasted through that. Okay. Now that you've done that, you can take a breather if you want. And I suspect even on a monthly chart, what you're going to see in the next week or so, let's say that's some downside, is going to be short-term noise. So if you're in call options that are about to expire and, et cetera, maybe you're concerned about that. But from an investment point of view, I think it's meaningless. And so a bad daily candle, fine. That's part of what I think is going to happen. You get some kind of little pause here, but you've just broken out. And that's true with XAU index as well. XAU is out above its. This is a different. This is GDX versus XAU.
Yeah. So this GDX versus the gold spot price. So and you can see.
Oh, versus gold spot. Yeah. Okay.
Yeah.
That is a very important chart. Yeah. You were in a range back in the 1980s to 2000 on XAU versus gold. A range that was in the 35% to 17.5% range. If you go back further, if you can, I don't know if you can. No, you can't. Okay. But if you just run XAU versus gold, you'll see it was in a range much higher than what you're seeing now. And when we went into that bear market, like 2011 to 15 in particular, the spread collapsed. You took GDX, for example, XAU versus gold down to 4%. And it was in a zone from 17.5 to 35% for decades. So you took it, you might as well take it at the zero. It was so dirt cheap. Yeah, this is okay. Anyway, it's you now come up out of the last several years of downtrend. You've come up out of it, and there is a base there. You can see the upper end of the base. We think this surge is going to get there. And we don't think it's going to stop this time. A lot of momentum factors say, no, you're coming up out of this base. You've spent a decade plus below that upper line, and you're surging now. And you can see that the last several months, the gold miners have beat gold dramatically, sharply. It's reflected in their price charts as well. Gold's gone up nicely, but they've gone vertical. When you come up through the top of that spread base, you're going to run up to levels that are like double to triple where you are now in relative performance. Now, I'm not saying it's going to happen in 3 months, but it's likely to happen in a year or so, maybe 2. But, I don't think it's a 10-year issue. And when you come up out of that base, you're going to gush up to about where you've got your line there. And in current value, that's, there's a void between here and there. And I think you're going to fill that void. And that's still cheap historically. When you go back to the 1980s and look, we've published this in our reports, XAU versus gold. This is apparently a little different. But it could double to triple in value, relative value, meaning over the next couple of years, it wouldn't be surprising to see gold miners do twice as well or 3 times as well as gold does.
And gold's not going to stay constant either.
No. And again, we keep making this point. I listened on, it was CNBC or Fox Business, I think it was CNBC this morning. Somebody chattering about, gold gone vertical. When you see vertical, it's time to take profits. Gold right now is 3.5-fold off of its bear low. In 2015, it was at 1,045 low. It's tripled in a half. Okay. If you do a logarithmic scale of gold, a ratio scale of its moves since 1975, when the government made it legal again, there have been 2 prior bull markets that were 8-fold moves. The one you're looking at there that went to 1980 and the one that peaked in 2011. If you go back to the bear low before that, different amount of years it took, but still there were 8-fold bull markets. We've gone up 3.5-fold. So, yeah, you might want to look at the price chart right now and say, oh, my gosh, that looks vertical. Yeah, fine. It's nowhere near even half what those prior bull markets did under conditions that are far less dynamic and pending fundamentally as the one we're in now, especially if you break the stock market. Because at that point, you're going to have all kinds of debt crises revealed, errors exposed. And I think a lot of them won't just be in AI, by the way. They're going to be in the financial sector, which we're keenly watching right now, where the central banks then go berserk. But what does that benefit? We know that when they start cutting rates, it didn't help the prior bear market stop. They just went on. Okay. Gold. It's just more fuel for gold. I think these conditions are now set, and gold could, even if it just went to 8,500, it would then be matching the percentage dynamics of its 2 prior bulls. I don't know that it even stopped there, because frankly, the world is different than it was then in terms of fundamental dynamics and things. So when people say, oh, it's overdone, geez, it's only freshly emerged from that range you see there. So, it's hardly overdone anyway. And I think people need to be aware of that. And
totally.
Go ahead. Yeah.
No, I was just going to say, and we also saw a beta test of what it would look like, how gold would perform in a market-wide sell-off. This was back in April. And if you recall, gold performed the best out of pretty much every other asset class during that.
It shot up nicely in April. The stock market collapsed. It went up. In fact, it went up from Jan to April. Stock went down from Jan to April. Okay, total opposites. And then when the stock market decided to go up, you think, well, the guys that bought gold as an alternative to stocks, shouldn't they be selling? It didn't go down. It went sideways. It went to sleep. So rather than going down while the stocks went up, it went sideways for 5 months. Total sleepiness, total support. And now it's reengaged again. It's not always, you don't always time gold with the stock market. But in major trends, it's inverse, especially major bear trends in the stock market. It's inverse to the stock market. It's always been, in fact, for 100 years it's been. Now, gold didn't trade back in the 1929s to 30s because, Roosevelt, okay, he took your gold away. But homestake mining went up like 1,000-fold. Okay, so gold miners went up while the stock market went down 80% over 2.5 years. Anyway, I think we're an interesting point, and I think the tipping of the stock market now that we've had the party and possibly the Fed tombstone on the market, a rate cut, we'll see. But if you ooze back down, handful of percentage points from where you are now, especially if you ever get back below the January price highs on the S&P, which is like, less than 10% from where you are now, the price guys are going to say, hey, I thought we had a breakout there. And when they realize it wasn't a breakout, they're going to get concerned. Momentum will get concerned before then. It's already broken. Momentum's broken long-term trends going back to 2022, whereas your price chart hasn't. Momentum has. So momentum is telling us now, don't trust these new highs. They're not likely to last, and they're likely to be teasers. And we'll find out shortly.
Interesting, because this rally seems to be driven by, I believe, was it Oracle? Is that a
recent one? Yeah, it could be. Yeah.
Oracle or whichever company Larry Ellison owns.
I thought, it was Oracle. Yeah.
Oracle. Yeah. So that's the big driver of this recent rally.
Yeah. But even the Mag 7 have gone. They're not doing what this is. I think it was only 3 of the Mag 7 have made new highs. Maybe I'm wrong. Maybe it's 4. But the Mag 7 were the leaders. Now it's only the Mag 3. Okay.
Now the Mag 1 in the form of Oracle.
Well, Oracle's not part of it. Not part of the Mag 7. So you're losing leadership. And when you look within the market, there's also sectors that have not made new highs, and also ones that have made new highs, but made it by, 0.5%, that type of thing. So there's a lot of front end loading in the S&P and the NASDAQ 100, where there's stocks up front, like 5 or 10, that constitute the weighting of, maybe the half the rest of the index, all because of the front end loaded ones. So to some extent, that's distorted. Anyway, we don't trust the stock market rally. We're focused particularly not on it as such, but on specific, especially debt-related stocks like some of the major banks and Visa and MasterCard, actually, ones we're watching keenly. They've got momentum trend structures that look potentially horrible, even though their price chart looks like, oh boy, I'm so happy. This is Visa with daily or what?
Visa on the monthly chart.
Okay, it's stalled, but it's okay. It looks good. You hear about consumer credit being overextended, delinquency rates, et cetera, right? Everybody using their card up to the hilt. So that indicates softness in the economy. But when you look at Oracle, it says, hey, I'm not worried about Visa or MasterCard. They're saying, I'm not worried about anything. Often stocks are wrong, just like at the .com top.
Yeah, the stock patterns are identical to one another. Both.
Yeah, or the guys in 2005 and 6, the big short guys, who said you're going to have a collapse because of the mortgage market. The mortgage market said, we don't care. Bernanke said, no problem. Okay, well, sometimes problems get ignored. And I think we're looking at momentum factors of these stocks, not the price charts. And it's almost always the case that at a major high, the stock market looks great.
Yeah. Well, before we wrap things up here, Michael, let's talk about silver here for a second. What's your prognosis on silver?
I think that the $50 highs, you're looking at one of them there, and there was one back in 1980, are going to be blown to hell out. And we're going to end up with a surge, this move that we're in right now, that's likely to only pause in the $65 to $70 range. I've got some reasons for that. That's not a top. In other words, that's where I think the next pause will be. Pause of what you would call significant pause, where you actually spend 2-3 months going sideways or down.
Mm-hmm.
But until you see that gusher, I wouldn't be concerned about it. I think you're going to, that'll wake up the sleepy audience out there when you take out the $250 highs. And finally, by the way, copper's above its 2011 high. You know that? Gold's above its 2011 high. Why can't silver be above its 2011 high? Okay, maybe it's somebody made a mistake. Markets often do that. They underprice themselves and they suddenly, I catch up. And I think that's what silver's in process of doing here.
Understood. And the silver miners, are they following the same fate as the gold miners?
No, the silver miners aren't as close to the 2000. Look at SIL, for example, SIL. It's a silver. It's in the 60s, and you'll know its high back then was in the 90s in 2011. So unlike GDX and XAU, which are above the 2011 highs, gold's above it, gold miners above it, silver's approaching, they're still a good distance away. But that recent action you see in SIL in price is more dynamic than it was in GDX even, and on a percentage basis. So when we run a spread chart measuring SIL price versus GDX monthly closes, what's the difference expressed as a percent? It's in the process of breaking out, meaning that it looks like the silver miners are in the process of shifting to an outperform mode versus gold miners. That would happen to fit with our view that silver's doing the same. So the place to look, we think, within the monetary metal area is silver and silver miners, less so gold and the gold miners. Though they're all going to go up together, I think that the silver components are going to go up far more on a percentage basis. A catch-up.
Right. Yeah, they do seem to be coiling up in this flag here with regards to SIL divided by
that's even, it's 90. Actually, when we do a monthly close only and do a parallel channel, through a downtrend, just a simple downtrend through the peak closes. Forget the highs and lows, just the closes of the months, the green bars you see there. You're out above it right now marginally. You're pressing at it. Let me put it that way. You close a month out anywhere near 95%. I think right now it's, what do you say, 93.75 or 93.80. So you're about 1% below where that spread breaks out big time. Yeah. And I think you'll gush up out of this basing action, which goes back to 2022. You're where you were then. So actually, if you bought silver miners in 2022, right now you're doing just as well as if you bought gold miners, meaning they're at the same percent level. Doesn't feel like it, but they have. And I think they're about to shift to outperform. This base looks like it's ripe for an upturn on performance. And you could gush up pretty dramatically. And that would translate to price dynamics as well.
Interesting. Well, Michael, it's been a fascinating discussion, as it always is. Anything else you want to bring up and talk about that we didn't get into before we close?
No, I just think that in the next 3 months, you're likely to see some of these dynamics astound you. I don't think the incremental nature of the bull market we've seen in gold and silver, which has now gone more accelerated, admittedly, we're going to go even more accelerated. And I think you're going to see that reflected in other markets the other way. And once the asset class breakage occurs in the bubble market, the stock market, U.S. stock market in particular, that money goes somewhere. It always does. It doesn't get burned up. Yeah, some of it gets burned up, but a lot of it goes somewhere else. And gold is almost always it's gold and monetary metals are the prime beneficiary. And so what we've seen in gold and silver is going to go more vertical, particularly in silver. And I think one of the factors there will be simply punch a hole in that stock market where the forever longs begin to doubt and move more money.
I see. Well, Michael, where can people find you if they want to see more of your work?
OliverMSA.com, Momentum Structural Analysis. Request a sample, but take time, read about our method. It's not orthodox. We've been around since 1992. So,
yeah. Well, that was So that's a few years after I was born. So you've been in the game for a while.
Alrighty. Okay.
All right. Well, hey guys, if you enjoyed this podcast, drop us a like, comment, go Michael, go in the comment section. If you enjoyed the podcast, if you disagreed or agreed, either way, let me know. I do in fact read the comments, and I will be responding to a small handful of comments. So if you want your voice to be heard and you want to get my attention, leave me feedback, whatever I do take all that good stuff to heart, good and bad actually. And subscribe to the channel so you don't miss an episode. And by liking, subscribing, commenting, doing all the YouTube stuff, you help in pushing this video and this channel in the algorithm. So it may not seem like much, but a little bit certainly goes a long way. And it's also free. So there's that. And then if you'd like to support us monetarily and become a paying member, you get all of my stuff early, ad-free, and uncensored for the videos that warrant it. You also get a chance to ask my guests questions and make guest recommendations down the line. So with all that said, I appreciate your time, guys. I'll catch you later. Bye.